Hi, everyone. Thank you for joining us today. As you're coming into our webinar room, I want to welcome you. My name is Marche. I am the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We are thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number and email address as well. If we can't get to your question during today's event, we will make sure to reach out to you after today's presentation to make sure that gets addressed. Again, we want this experience to be as educational as possible, so please don't hesitate to ask for a clarification or expansion of the material. Well, I'd love to introduce you to our guest speaker today. JR is a certified financial planning practitioner that utilizes a unique approach and methodology called financial life planning. Life planning connects the dots between our financial realities and the lives we long to live. This method is based on the premise that advisors should first discover a client's most essential goals in life before formulating a financial plan, so a client's finances fully support those goals. As a lifelong learner, musician, and athlete, JR holds a black belt in Brazilian Jiu-Jitsu, and trains Muay Thai, sorry about that, and has been playing the guitar for over 30 years. He actively performs and writes music in his band. And JR, we're glad to have you back. And we're going to talk about 401ks today. So I'm going to go ahead and turn over the time to you.
Okay, thank you very much, Marche, and welcome everyone. Today we're going to be discussing, will my 401k be enough for retirement? And hopefully I'm going to give a lot of shock value here in this presentation.
Okay, looking forward to it. Let's get going.
All right, so first slide, the 401k started way back when in the late 70s and gained popularity mostly in the early 80s, and then came into being the predominant retirement strategy by the mid 90s. My job as what I would define as a financial planner, so helping someone coordinate a retirement and being able to live, a great life in retirement. We weren't really that popular back then. We were more along the lines of what you would use to, I remember the term called stockbroker was sort of what they used to call us, because that was like a method by which people saved money. But the reason why we weren't so popular financial planners to help people retire is because people had something called a pension. And what happened was, it was typical that people would work for the same company for 30 years, make a salary. By the end of that 30-year time frame, they would retire in their mid-60s, and they were guaranteed a portion or a major portion of that salary every year for the rest of their lives. And their retirement was handled. They didn't have to worry about it. And then the 401k came along. When the 401k came along, as it says right there on the slide, is that the responsibility moved from the company that you work for, guaranteeing your income for the rest of your life, to now you. You are responsible for your retirement. You are responsible for saving money. And that is what happened. So it's really important to understand that it's your responsibility now to take care of your retirement and seek the professional help that you need, or do it on your own, and make sure that those dollars last every month throughout your retirement, and make sure that, of course, you don't run out, right? So that would be good. All right, so
Right.
that's the concept. And
We did have a comment here is that that when pensions, excuse me, when pensions were more popular, the life expectancy was much less. And so likely 401ks also have reduced the burden because, people are living longer now.
Sure. Yeah, that's a great comment.
Yeah, good comment. All right, let's go ahead and move on.
Okay, now this is not a 401k bashing ceremony. This is just to call it what it is, right? Define what a 401k truly is. And one of the things about a 401k that most financial professionals would agree on is that there's some really great attributes to a 401k, which we listed right here, right? The fact that the company you're working for is going to add in money on your behalf is fantastic. I love that, right? So they're speeding up the rate at which that money will grow over time. Can't say anything bad about that. You're automatically entered into it for the most part. Most companies just put you in, all right? And they'll put some percentage and you're in, and that's forced savings, right? So love that. We love forced savings. Auto draft, you don't have to think about it. The money comes out automatically, and it's on autopilot. I think that's fantastic. It's a great way to save. And what happens is, this is really interesting. When people are forced into a situation where they have to only live off of the dollars that are showing up into their checking account, they adjust their life to those dollars, right? If your health insurance was not auto drafted out of your paycheck, I promise you there'd be a lot of people in this country right now, a lot more without health insurance, right? It's the same concept. So having that money taken away from you before you had the chance to spend it is, to me, for the sake of retirement and future savings, a great strategy. It is protected from many, many, many lawsuits. If you get sued and are found guilty of some sort of situation, a financial burden, they cannot dive into your retirement 401k and take the money out for that lawsuit, which is awesome. And then the deduction that you receive. So the deduction is, so I'm not a CPA, so I can't speak on behalf, but generally speaking, what happens is, if you make $100,000 for the year and they take out $10,000, you contributed $10,000 to your 401k, those $10,000 escape taxation for the year, okay? And then it looks like to the IRS that you earned $90,000, not $100,000, when they go and do your tax, when they do your taxes every year come April. So that's essentially the deduction you receive from your income.
Let's go ahead and move on to the cons.
Okay. All right. So there are some challenges with a 401k. So limited investment options. Most 401k companies limit what you can invest in. Typically, they leave it to a number. I mean, you get options. This is just not, let's not say that you don't have options, but it's basically limited to mutual funds and ETFs and or what we call exchange traded funds. And then what we call something called target date funds. And most people are using target date funds, whether they know it or not. And target date funds are mutual funds or ETFs or combinations that sort of, as they prep you for retirement over the course of time. So essentially what they do is, for people who don't understand what a target date fund is if you're younger, in your younger years, call it 20s and 30s and 40s, the risk exposure or the exposure to stocks is high, right? And as time goes on, and then also in those same years, your portfolio is not so much invested in bonds or fixed income strategies. And then over time, as you get older, they convert your portfolio from what we would call an aggressive portfolio to a more conservative portfolio, adding more bonds and fixed income later on in life, and less stocks. If that's how you want it to be, that's what you get. But financial planning and investment strategies should be customized to you, not to some general concept. Not to say one's better or worse than the other. It's just that, in my opinion, you would want your strategy customized to you, what you think is appropriate. Nobody likes to pay penalties. So yes, there are penalties if you take those dollars out before you are 59 and a half years old. There are ways around the penalties, and like for certain specific situations that you guys can look up and figure out what those are. Okay, so the loan on a 401k actually is not a bad thing, right? It is great that you can take money out of your 401k today and spend it on the things that you need it for today, which I think is a good, flexible situation. But with all loans, you now have to pay it back. So now your cash flow has been compromised, right? So less cash flow for savings. And then there's interest. Now everyone goes, yeah, but I'm paying myself back. Well, that's not exactly how it works. You are paying yourself back with interest, but who receives that interest? Well, you, right, your account, but someone else does, and that's the IRS and the government when you take those dollars back out in retirement. So they do get a piece of that interest. So it's not entirely yours, most of it's yours. Right? Well, I don't want to say most. It's just some is yours, some is the government. Okay, required minimum distributions. Okay, so the way it is right now, when you are 72 years old, you have to take the money out of the 401k. You cannot leave it there, okay? You leave it there, you're gonna pay a penalty, right? So that's not good. Why would you want to pay a penalty on your own money? That seems to be not a good thing. So you are forced to take money out. Now, is that a good thing or a bad thing? It depends on your perspective, right? If you're forced to take the money out, that means it can't sit there and grow anymore, correct? So you would, and not only do you have to take what happened when you take the money out, you're going to pay taxes on those dollars, whether you wanted to or not. So I don't like that being it's like a control thing, right? You're not in control of that situation. Someone else is demanding you make a decision about your money, whether you want to or not. Now, what you do with those dollars after you take it out is your right. You can put it right back into the stock market if you so desire, but yeah, you're being forced to pay those taxes in that moment, in that year. Okay.
I had a question here about RMDs. Is there a certain percentage that you have to take out at 72?
Yes, it is a formula that is a little weird and complicated. I mean, it's not hard to do. It's like there's tables on the IRS from the IRS that you can utilize to figure out what the amount is, and then it's essentially a dollar amount. I don't want to quote it and say it's like 3 or 4% in year one, but like let's just pretend that's what it was, right? Of the dollars in the account, and then every year it goes up. So it's every year you have to take out more and more and more and more. So
and a follow-up questions to that percentage calculation that could change in the future, correct?
Yeah, well, anything's possible. The rules are subject to change whenever they so desire, whoever they are, right? The government, the legislatures, the IRS,
okay.
That sort of thing. Okay. So a little bit of funny time right now, lots of little jokes, but so the liability of taxes in a future tax bracket. Okay, so here's the joke. Do you want to retire wealthy or do you want to retire poor? Now, the joke is, I would hope that everybody's laughing going, well, of course I want to retire wealthy. Why would I not? Well, guess what? When you are wealthy, typically you are forced into a higher tax bracket, right? So if you get what you want, and what you want is to be wealthy, your tax bracket becomes higher. Therefore, the amount of money that you pull out of your RMD or your 401k is subject to higher taxes in the future. Now, if you show up to retirement and you're not in a high tax bracket, congratulations. But that also could mean, you're not doing well financially, right? So like see, the thing about a 401k, which I'll get to, is we don't know what the future beholds. As of right now, the tax brackets are what they are. Those are subject to change in the next 20, 30 years, right? So I could give you an idea of what your liability will be today, but I have no idea what it's going to be 5 years from now, 10 years from now. And so yeah, you have no clue what your tax bracket could be. It could potentially be higher, but of course, I have to be honest, it could potentially be lower, right? So we don't know. Yeah, I'll leave it there at that. Inheritance restrictions. So they recently changed the laws on these inheritance restrictions, right? It used to be like certain people were able to just take those dollars that's left over in your 401k when you pass away, and you can just make it part of your retirement plan and your 401k. They stopped doing that for most people, except for your spouse. Now, like for instance, your children have to take those dollars out of that inheritance within a period of time. Right now it's 10 years, so it has to be removed. Again, the reason why these money dollars have to be taken out is, of course, is so that you pay the taxes on it more now than later on and do it slowly over time. And essentially, that's what I think the reason is for it. Okay, now the last thing on here is a 401k is a tool that is meant to be spent down to zero. So that's my take on it, which I think is kind of a good thing, right? Because like one of the things I talk a lot about in financial planning is I want people to spend their money. Like I want on the day that you go away, right, that we disappear from the planet, that you have $1 left in the account, right? That would be the perfect scenario. Therefore, I did my job correctly. You spent all your dollars, your hard-earned dollars, and now there's nothing left, right? That's fantastic. Now, we're not discussing what we leave to our heirs, of course. Like there's a whole bunch of strategies we can create such that if you spent all your dollars down to zero, they still get something, and not only just something fantastic, right? There's ways to create that. But, and it goes back to this inheritance restriction thing, right? So if it's not an efficient tool of the 401k to pass on to heirs. That's essentially the concept. It's just another way of saying that before. So we want to be cognizant of what tool do I use to pass on wealth to the next generation. Okay. Next slide says the 401k isn't a financial plan. That is correct. To me, a financial plan has a lot of different components. One of the components you should use, right, and consider is the 401k, but it's one of many. It is quite common that most people in our country, their 401k won't be enough money for them to save, right? It's just not, there's a lot of different reasons for that. One, you haven't put enough money in. One is the restriction, right? There's a restriction on how much you can put in, right? If you're somebody that's wealthy, right, you can only put a certain percentage in per year. It might not be enough to live your lifestyle, so the money has to go somewhere else, right? So depending upon your lifestyle, that's a you know, how much goes into a 401k matters. You do have other options for investing in your future. As you can see on the slide here, we have Roth. Roths are a powerful financial planning tool that allows us to save in a similar fashion, like a 401k, a traditional 401k, but when we receive the funds in retirement, we receive them without a tax burden, right? But we pay the taxes today, right? That's the distinction. Conversions, we can actually strategically convert our traditional 401ks into Roths as time goes on. Typically, you would want to do something like that in a year where your current year tax burden is low. If I have a low tax burden for the year, a Roth conversion is a powerful tool because I won't pay as much money in that conversion in taxes in that year. Real estate is a fantastic financial product to utilize for retirement, can be utilized for tax planning, a great financial tool. Real estate's complicated though. It's not just like, let's just not go out and buy real estate tomorrow, right? We have to really consider it. There's new kinds of financial products built inside of real estate. I'm not saying you should use them, but you need to be aware, right? We can do refinances, cash out refinances. We can do home equity lines of credit. And the new tool, which is the reverse mortgage, has its pros and cons as well in the world of financial planning. And then we have alternative assets, right? Alternative assets can be anything from your business, right? If you have your own business, the assets inside of the business is an alternative. There's things like precious metals, there's insurance products, there's annuities, there's all kinds of financial tools that we can bring to the table in order to have a sound financial plan in retirement. And there's things that we want to have. Retirement should be, in my opinion, a time of joy and confidence and having a good time, and using these tools strategically puts you in a better position, right? Because if all of it's funneled inside of one tool, you are a slave to the functions of that tool. So that's why you want to, I don't know. I love the concept of having options when you are doing your financial planning. Better to have choices than not. Next slide. Okay, so why does the financial planner become a valuable person in your life? It's because of what a financial plan is, right? So in my opinion, a financial planner first step identifies what it is that you truly want. What is the life that's going to make you feel inspired? When you have an inspired life and you feel motivated and you have someone holding you accountable to achieving the goals that you set, the probability of you achieving those goals goes up. I mean, that's just the way it works. So the first thing a financial planner does is identify the goals. The goals are retirement, starting a new business, because some people always wanted to start a business. Some people are excited about being a creative, like the musicians, the athletes of the world. Those things are great. Traveling is another thing that people want to do. So you have to make it a plan in order to achieve those goals. And then you set out the plan of how you're going to fund these things. And then you use the tools strategically and creatively, like the 401k, the Roth, the IRAs, your checking and savings accounts, and all those alternative assets that we were talking about a few moments ago to fulfill on the financial plan. To me, that's the way it's done properly. This can be done on your own. You just got to do the homework and the research necessary so you don't make mistakes, or you hire someone to do the work. That to me seems the best strategy for achieving your future financial goals. And the other thing that people, having someone on your side, getting you to like progress in your career is another great strategy, whether it's your financial professional or you hire someone to help you progress and get those higher incomes and get those promotions and achieve the goals if you're your own business owner, right? Having someone on your side helping you achieve new business goals is always a great thing. Okay, next slide. And that's where I want to kind of stop it. Yeah. And
what we're going to do is we're going to open up to some questions, right? So I had a couple questions come in, and I will tell our audience to go ahead and put your questions in the chat. We'll make sure to get to them as we have time today. So here's a question. Are there RMDs on Roth IRAs or Roth 401ks? Do you have to do a retired minimum distribution on your Roth?
No, I believe that's correct. You don't. Yeah.
Okay. Here's a good one. Is there a certain percentage one should save out of your income to adequately prepare for retirement?
Yes. I wanted to comment on it. Thank you for asking that question. That was something I wanted to say. Okay. So there's been a lot of research on the amount of money you should set aside. So this is what you should set aside, not what other people or other companies are contributing. In my opinion, a person should set aside 15% of their gross annual income. Gross. I did not say what you net. All right. We can have the argument offline on another day, but that's the amount I want you to save. So if a family's making, just to give you an example, the family's making $100,000 a year. My request, I'm on my hands and knees begging, please set aside $15,000 of your $100,000 for wealth building initiatives. Okay, or $1,250 a month is the same number, right? We do that, typically we do this monthly. Right now, if you had $50,000 in income, 15% of that, 200,000, 15% of that, depending upon how much money you make, it's always 15%. That's the number that I recommend to people. There's been books written on it. I think a famous book is called The Richest Man in Babylon. That author said 10%, but that was an old book and things have changed since then. I've heard that if you make over a certain amount of money per year, you should be saving 20% of your money per year because you can. Now, that is for people starting out, right? It's the ages 20, 30, 40 kind of range. However, you can reverse engineer the number, right? If I know how much I need to live off of in retirement, right? And some people do have a good concept of what that number needs to be. You reverse engineer and work backwards. If I know that I need to spend a certain amount of money per year, and I'm only going to withdraw a certain percentage of my funds out of my account per year, I can figure out how much money I need to have by some point in the future. And then I can reverse engineer and say, well, that means I need to set aside these dollars per year or per month in order to achieve that dollar amount, in order to spend that much money in the future. Now, I just used a verbal way of saying a formula, which is complicated, right? So you can do this on a calculator pretty quickly. We have financial planning software programs. Most of the 401k companies that you guys utilize have these tools inside of their like these software programs and calculators inside their programs. They can give you the answer to that. So the point is if you're starting out young, it's like the 15% rule, the 20% rule, that sort of thing. If you're maybe later on down the line, you're like, well, how much do I need to save? Which might be a bigger number because you're trying to catch up. A lot of people are later in life are trying to catch up to a number. You might have to reverse engineer and figure out how much you need to save. That's how I would answer that question.
Thank you so much. We did have a follow-up to that, but I can't find it here in the chat, so I will come back to that. This is a question just about financial planners in general. So it says, I'm in my late 50s looking towards retirement, but my financial planner is significantly younger than I. Should I be worried that they're not in the same kind of life cycle or lifetime as me, and they don't necessarily understand where I am?
Good question. So the answer is it's a tough question, a tough answer, because if the younger person is properly trained, they understand the things that the person needs to be prepared for in the future. Like there's some great schools and classes that teach us how to help people prepare for their retirement, right? So that is 100% without a doubt true, right? Like we can be educated as younger professionals and we get experience working with older people and learn about their experiences, okay? Typically, we're also gonna be with them for their whole retirement, right? Because we tend to be younger than them, so we'll be on that journey with them through their life, right? We won't pass away as quickly, right? So that's a benefit to having a younger person. Now, the actual life experience of being retired will not be had by the younger professional, right? That is without a doubt true. So we can't just be like, oh, I know what it's like being on, I personally know what it's like being on Medicare, right? They can't say that. They have no idea what it's like. We can only hear about it, okay? We can only hear from our clients. So yeah, so there's obviously a pro to having someone who's up in age when you're thinking about retirement. But remember, the higher they are in age, the higher the probability they're going to pass away before you do, right? And that's a problem, right? So they better have a succession plan, which a lot of financial professionals have to have now, is succession plans in the event that they pass away and your retirement is entangled in their system and their process, right? So that's important.
Good question here. All right, I found that follow-up question. When you were talking about the percentage about preparing for retirement, what if your family is really long living? Does that change that formula?
Oh yeah. The longer, if you have it's in one of the tools that I utilize, it asks the question, do does your family tend to live longer than others? And the answer is yes. It's like, all right, well, you got a plan to age 100 and the other person gets the plan to age 90. And and you can see, like, when you run the numbers, you have to save more money if your life expectancy is longer. So yeah, it matters, right? So you would have to run an analysis, and there's, again, some really powerful financial planning tools out there that can run the analysis. All right, well, if my planning age is 95, how much do I need? Or how much can I spend in retirement? If my planning age is 100, how much money should I plan to spend? How much should I save? And then these programs are moving to 110, 120 now, because that's where they're thinking this is going, that people should be prepared to have money that late in the game. So yeah, it's a real thing.
Very interesting. This one has to do with aging as well. What about planning for significant health events like dementia or Alzheimer's?
Yeah, I mean, again, financial planning is not a 401k, right? It's the whole system. The whole system says, what happens if I end up needing major healthcare and the financial burden of that? What tools do I utilize? Do I need to prepare for that now, right? Do we use insurances strategically, right? That becomes a topic when doing retirement planning, right? Retirement planning is not how much money you have in retirement only. It's all the different things that could happen that could potentially cause a financial disaster, because that's what it is, right? If I get sick or injured in retirement and I haven't planned for the financial disaster that could cause, it will be a financial disaster. So you got to plan for it. And remember, this is not just a conversation around money. It's who are the team members involved, right? So I need a team for financial planning in retirement. And a team sounds something like this: the tax professional, the CPA, the lawyer, right? Maybe different lawyers. It could be a trust and estate lawyer. It could be a family law lawyer, a different lawyer, right? The real estate lawyer are all people that I need in that circle. It's the insurance agents. It's the health insurance agent, right? Or the Medicare agent. It's the life insurance agent, the property and casualty agent, the insurance agent that does the long-term care insurance. It's like there's these teams of people we need in our lives running the show. Typically, the financial planner runs the team, right? Because they're probably most involved with all the different aspects of it, but you're going to need a team of people in retirement, and you have to manage the cast of characters is what I call
it. All right, we have time for a couple more questions. This is just a kind of a nuts and bolts question. When can you actually start withdrawing from your 401k without penalty, I guess?
Well, the first answer is 59 and a half is the year in which you're good to take it out. But then there's a couple, well, again, so there's reasons you can take money out, like if things happen and go wrong in life, like there's certain, like for instance, if you get a disability before 59 and a half, that opens up the ability to take money out. So there's a lot of different rules that I'm not going to explain now what gets you out of it. There's too many to list. There's even certain situations, there's all kinds of strategies and IRS codes that you bring a CPA into the conversation and say, I need to take the money out. I believe there's one around it's either age 50 or 55. I can't remember off the top of my head. I had to take a test on this and I passed. I know that, but
it's available for you to look up. So
yeah, you can look it up. I think it's age 50, and as long as you take a certain amount of money out every year, then you can and you guarantee that you take the money out, then you can avoid the penalty. But if you mess it up along the way, you're back to paying the penalty again. So it's like there's these really strict rules that have to be reviewed by multiple professionals before you go and do stuff like that. But I believe it's age 50. But then again, it doesn't have to be age 50. It could be, well, if you had a disability, then you take the money out and it didn't have to do anything with your age, right? So there's a lot of rules around it. And then there's real estate transactions or ways that you can take money out of your, but there's rules with that as well. And then loans is another way to take out money without penalty, right? So.
All right. And here's our last question. Does it make sense to meet with a financial advisor if I only have a 401k and I'm already saving 15%?
They know what my answer is going to be, right? So of course I think it's a great idea to meet a professional. At least you don't have to hire them, but definitely talk to them, because get a new perspective, right? Financial professionals deal with these concepts all day long. We know where things go wrong, right? Again, so I'm saving 15%. I have a 401k, and all you're thinking about is dollars and cents. It's not only a dollars and cents conversation. It's goals. It's what happens if you get sick. It's family. It's estate planning. It's tax planning. It's all these things that go into it. Investment strategy that has to be discussed and strategize in order to do this thing correctly. Otherwise, you run the risk of making a mistake. And when you make a mistake, two things happen. This is what I say to people. You either make a mistake and you lose money, right? Which makes a lot of sense, or you miss out on money. People miss out on money all the time in finance because they don't understand how financial tools and products truly operate. And so if you don't know how they truly operate, and you're not an expert on how they truly operate, you run the risk of running a mistake. So speak to a professional. They will give you the details of the way the products work. And if you feel like, see, there's nothing wrong with do it yourself. There's nothing wrong with it. You just make sure you're educated. And sometimes just getting a quick little education from a financial professional is, worth a lot. It's worth a lot.
Well, thank you folks for your questions. I will say, as I'm doing my outro, if we haven't had a chance to get to your question, or if you have a question that came up, go ahead and leave that in the chat. Again, leave your contact information so that I can download those and get those to our team, who are happy to reach out to you and make sure that question gets answered. On behalf of Advice Chaser, we want to thank JR for being here today, and for the organizations that have made this webinar possible today. Thank you so much for attending. Look for an email soon to the link that will include the link to the replay of this event. And you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Bye, everyone.